Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Strive.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
I think we have to start by just acknowledging the company we're discussing today is, well, it's not the same company it was a few months ago.
Not even close. Strive has gone through what you could only call a complete corporate metamorphosis.
It's more than just a rebrand, right? This feels like a hard strategic realignment.
Hard turn is exactly the right phrase. The big event was the merger with ASST entities, which, officially closed back in September.
And before that, they were in social media tech, which is a whole different ballgame.
A completely different world.
Yeah.
A relatively niche area. But since that merger, the focus has switched entirely. They're now positioning themselves as one of the very first publicly traded asset management firms focused on Bitcoin treasury management.
That is a staggering change. I mean, to just abandon your core business model for something so different and so volatile. How did they actually manage that from a governance side?
They moved incredibly fast. Post-merger, they set up a new shareholder agreement, and they strategically brought in some key figures from politics and investment.
Ah, okay.
Yeah, the inclusion of investors affiliated with Vivek Ramaswamy, for example, that helped align the whole structure to this new, really aggressive mandate. They just wiped the slate clean.
And brought in people who shared that vision.
Exactly. People ready to make them a major public steward of Bitcoin.
Okay, but to be a leader in that space, you need capital, a lot of it. You can't manage a Bitcoin treasury without, well, a treasury full of Bitcoin.
You can't. And they were very proactive about it.
Yeah.
We saw a really big move in November with a preferred stock offering.
And how did that go?
Successfully. They secured approximately $149.3 million. And what's really crucial here is they said this money was specifically to buy more Bitcoin.
So not just for general operations.
Right. It was a direct signal to the market that the Bitcoin balance sheet is now the absolute core of their value.
Okay, so let's try to unpack this because it's a bit of a financial paradox, isn't it?
Right.
On one hand, you look at their balance sheet and it looks almost boringly safe.
That's the good news side of it, and it's a really important place to start. I mean, despite all the chaos of this huge pivot and the M&A costs,
Right.
the balance sheet itself shows exceptional health. After that capital raise, their cash position is just robust. We're talking about securing around $160 million in cash.
And what about their short-term liabilities? For a company in transition, that's often where the danger is.
Liquidity is fantastic. Their current ratio is 4.7.
Wow.
Yeah. So for anyone listening, that means they have $4.70 in assets for every single dollar they owe in the short term. Most healthy companies are happy with a 1.5 or 2.
So 4.7 is basically a war chest.
It is. But the most shocking number, especially today, is their debt.
Which is?
Effectively zero. A debt-to-equity ratio of 0%.
In this interest rate environment, that's a massive advantage. It means no default risk, no interest payments dragging them down.
It gives them total freedom.
But let me play devil's advocate for a second.
Go for it.
With the goal of massive expansion in a capital-intensive field like Bitcoin, is zero debt maybe too conservative? Are they leaving growth on the table?
That's a really valid and critical question. And for a lot of companies, yes, a little leverage can boost returns.
But not here.
I think in their case, their main asset, Bitcoin, is just so volatile. That zero debt position is their safety net. It means if the crypto market takes a nosedive, they don't have debt payments breathing down their neck.
So they're choosing stability over speed.
They're prioritizing survival and flexibility. In this sector, that's probably the smart move.
Okay, so here's where the paradox really kicks in. The balance sheet is a rock, but the income statement, it looks genuinely terrifying.
Right. You're talking about the losses. In Q2 2025, revenue was just $633,000.
And the net loss was?
What was it? A massive $266.46 million.
And those profit margins, I mean, they're just brutal. The EBIT margin is negative 996.1%. A 4-digit negative margin is a huge red flag.
It's a massive sticker shock, for sure. If you just stopped your analysis right there, you'd run away.
So what's the context? How is this not just an unsustainable cash burn?
Well, most of that $266 million loss isn't from day-to-day operations. It's things like, non-cash write-downs, goodwill impairment.
All the accounting tied to the merger and shutting down the old business.
Exactly. Huge M&A-related expenses. The market is basically looking past that.
So investors are just ignoring those backward-looking numbers.
The sophisticated ones are. They're betting on the future. They're looking for that earnings inflection point when the new higher revenue asset management model really starts to ramp up.
It's a pure transformation play then, purely about future potential.
Which is why there's such a significant risk premium.
And you can certainly see that risk reflected in the share price. This stock is not for the faint of heart.
Absolutely not. Over the past 3 months, it's been all over the place. A low of 78 cents and highs well above $1.72.
We just saw that sharp rally, 6.25% in mid-November after an announcement. The one-month gain is almost 25%.
When it moves fast.
Let's talk about that movement, because the beta on this stock tells you everything.
It really does. The beta is an extremely high 17.4, and we cannot overstate what that means.
So just to break that down for our listeners.
Right. So beta measures volatility against the overall market, like the S&P 500.
Give us a real-world example. If the S&P moves 1%.
Strive could, theoretically, swing by 17.4% in the same direction. That is just massive exposure. It confirms this ultra-high volatility.
Which creates trading opportunities, I suppose, but you need an iron stomach.
And ironclad risk management, absolutely.
So where are the key technical levels traders are watching?
The big psychological support seems to be anchored right around that $1 mark. It's been tested, it's held, which is a good sign.
And resistant.
That's sitting up near the $1.77 to $1.75 range. If it can break convincingly above that, that would be a very strong signal.
What's so interesting to me is that despite the crazy volatility and those scary income statement numbers, sentiment is actually really positive.
It is. Retail sentiment is robust. They're excited about the crypto exposure. But it's not just retail. We're seeing mounting institutional interest, too.
From the IPO participation.
Yes, and the large block trades we've seen since. It shows the professional money is getting comfortable with this high-risk, high-reward profile.
So everyone is looking to the next few months, which are absolutely packed. This feels like a critical period.
It is. The calendar is jammed. All eyes are on 2 key dates. The Q3 earnings on December 9, and then Q4 on February 7.
And these aren't just routine reports, are they?
Not at all. These are the first reports that will give us a really clear picture of the new company post-merger, post-capital raise.
And investors will be looking for specific metrics, I imagine, not just top-line revenue.
Exactly. They need to prove the new Bitcoin treasury strategy is working. They'll be looking at assets under management, fee structures, and the treasury mark-to-market results.
The big question is this new model actually delivering?
That's the billion-dollar question, or in this case, the $266 million question.
And beyond their own financials, there are bigger market events that could cause some waves.
For sure. We've got the major ETF rebalancing event on December 18. Any news about institutional fund flows into digital assets could really move this stock.
Then in the new year, we get a look at who's holding it.
Yep, the institutional disclosures on January 26. We'll see which big funds have jumped in, which always acts as a bullish signal.
You also mentioned something about a special Bitcoin report.
Yes, on January 10. This is unique. Strive is expected to provide some real transparency on their capital allocation model.
Yeah.
It's about setting a new standard for how public companies should manage these assets.
So they need to prove it's an active, well-thought-out strategy.
And not just a passive holding, yes.
Which brings us to speculation. The buzz around this company is pretty loud right now, fueled by what they might do next.
Oh, the market is thriving on it. There are several high-impact rumors floating around. One is about potential digital asset acquisitions.
So buying up smaller firms or more Bitcoin directly?
Exactly. A consolidation play in a very new sector.
And I've heard chatter about a big partnership.
Right. The rumor is a potential revenue-sharing deal with a major crypto exchange. That would instantly broaden their client base and could really accelerate revenue.
There are also rumors about how they might keep funding all this.
That ties into their at-the-market, or ATM, share offering. The word is they might increase its size if the stock price stays favorable.
Which is a good sign, right? It's a less disruptive way to raise cash.
It is. It's a sign of confidence. It lets them raise capital continuously without a big dilutive secondary offering.
Now, these acquisition rumors seem to tie into a bigger move, the proposed buyout of Semler Scientific. This is where it goes beyond just Bitcoin.
It is. And if that buyout succeeds, it's a brilliant diversification move. Semler is in health technology.
But why health tech? That seems like it's coming out of left field.
Well, it serves 2 purposes. First, it's simple diversification away from the crypto market's volatility.
Okay, that makes sense.
But second, there are potential tech synergies. Health tech needs secure data management, right? They're looking at blockchain for records, for payments.
And Strive has that fintech infrastructure.
They're building it. They could leverage that expertise to bring secure financial tech into Semler's health data platforms. It's about building a diversified platform with financial innovation at its core.
So the big picture is a dual strategy. Dominate the Bitcoin asset management space while also building a foundation in something totally different like health tech.
Precisely. They're using their new capital to consolidate and form alliances. The long-term goal isn't just to ride the price of Bitcoin, but to be a scalable financial services platform ready for when digital assets go truly mainstream.
So, to wrap this all up, you have this incredibly volatile company that has completely reinvented itself around Bitcoin.
That's the heart of the high-risk, high-reward proposition. You have high operational risk and negative margins right now, but that's balanced by a unique model, a cash-rich, zero-debt balance sheet, and a calendar just packed with catalysts.
So the short term looks really interesting for tactical traders with all those reports coming up.
Definitely. While the long-term appeals to patient investors looking for a leader in a brand new asset class, the key question for you, the listener, is whether you are comfortable riding that 17.4 beta into the new year, trusting the stability of their balance sheet will see them through the extreme swings.